Real estate investment presentation, mortgage interest deduction. Get ready because we're raising the stakes with real estate. When thinking about the mortgage interest deduction, we're talking about income taxes, specifically federal income taxes here. When we do so, we want to keep in mind the tax code can change over time as laws change over time. That's going to be important when we're thinking about kind of a long-term investment here because there is risk with the uncertainty of what the law can do in the future. Now, the mortgage interest deduction has been around for a long period of time. You would think it unlikely that they would simply remove it. However, as we'll see here, they can make changes to the law that can make it more or less impactful for different types or categories of taxpayers. So again, you want to kind of keep that in mind as you consider it as a factor with a long-term investment such as an investment in real estate often is. So also note that we're going to be referencing Investopedia here by Julia Kagan. Investopedia being a place you can go to look up investment-related terminology, continuing your research from there. So what is a mortgage interest deduction? The mortgage interest deduction is a common itemized deduction that allows homeowners to deduct the interest they pay on any loan used to build, purchase, or make improvements upon their residence from taxable income. Now, note just right from the start, if you're talking about an individual and you're thinking about their personal investments, that's a little bit unusual of a deduction for income tax purposes. In other words, if you think about an income tax, what kinds of things would naturally be deductible for an income tax? You would think the kinds of things that you would need to spend in order to generate the income. In other words, if you're going to tax me on my income, it would not seem fair to tax me on my gross income and not give me the benefit of those things I needed to spend in order to generate that income. It would make more sense to tax me on my net income. So just naturally from an income tax, you would expect that I would get to deduct those kind of things that I needed to expend in order to generate the income. Therefore, you tax me on the net income. When you talk about a home, if it's a personal residence that I'm purchasing, you would think that would be a personal purchase from an income standpoint, an income tax standpoint, and therefore, in general, you would think it would not be deductible unless there was some kind of special exception, because it would be like buying a boat or buying a car or something like that, which you don't need for business unless it was a business purpose. It was a personal thing, and therefore that generally wouldn't be deductible for income tax purposes. Obviously, a long time ago, they made the exception, in essence, for some of these items with regards to the real estate. So the real estate then, because it's your home and they're trying to incentivize home purchase and so on and so forth, then they allow the deduction of the financing of the interest. So that's basically what we're talking about here. If you purchase the home, generally, you can talk about other loans that basically have the home as collateral on it. Then the interest that you're paying on the financing of the home is the portion that could often be deductible. It can often be, of course, a significant deduction, especially if you're in an area with high housing costs, high costs of living. And it's one of those deductions that can kind of push people over from the standard deduction to itemizing. But you want to be careful with it because you can overstate how big the deduction is, and you can also overstate the impact of it when you're thinking about real estate investment, because the market's going to take any of these kind of changes into consideration, and they're going to basically put it into, it's going to be baked in the cake, as they say, with kind of the housing prices in general as well. So we want to take that into consideration. In other words, some economists might argue that basically if you change the environment with kind of deductions, in the long run, it's going to equal itself out by basically increasing the prices to take into consideration changes of that nature. But in any case, the mortgage interest deduction can also be taken on loans for second homes and vacation residence with certain limitations. So with regards to investing in property, it could be a significant impact as well with regards to those investing decisions. So what is the mortgage interest deduction? The amount of deductible mortgage interest is reported each year by the mortgage company on Form 1098. So in essence, you take out the loan, you got the loan, you're using the property as financing on the loan. Typically then the government requires that the mortgage company lets you know how much you have paid with the tax form 1098. Now, the 1098 is a little bit different than a 1099. A 1099 usually represents some type of income that you got that you might have to report on taxes, which would be bad generally because it's an income tax and they would possibly tax you on part of that income. The 1098 is basically here is going to show you something that you could possibly get a benefit from, which would be the interest portion of the debt that you paid that you may be able to then report if it was your personal residence, most likely on the Schedule A. So this deduction is offered as an incentive for homeowners. That's one of the major kind of arguments from just a standpoint of policy, tax code being public policy. Why would you have the deduction? Because we're trying to incentivize people to get the home, to have more people in homes, because it's thought that that would be, better. And it's also a big industry to put people in homes. So you would think that a lot of people, just from an industry standpoint, would be influencing government policy from that side as well. But in any case, it is what it is. How a mortgage interest deduction works. Introduced along with the income tax in 1913, the mortgage interest deduction has since become the favorite tax deduction for millions of U.S. homeowners. So it's been in place for a long period of time. Home mortgage interest is reported on Schedule A of Form 1040 tax form. So if you have your personal residence generally, and it's your home and your principal residence, then you're going to get that form, the tax form, on at the 1098, and you'll typically reporting it on Schedule A. Now you might be saying, hey, I've never reported a Schedule A before, because that's an itemized deduction, and you would only be itemizing if you have itemized deductions that are greater than your standard deduction. Now, what kind of people have itemized greater than the standard deduction? Usually those that have real estate, because the real estate is the thing, oftentimes, the loan on it, the interest and the property taxes, that pushes people over that limit from itemizing to itemizing from taking the standard deduction. But that gap between the standard deduction and itemizing is a gap that you're not really getting the benefit on, because you get the standard deduction anyways. So it gets a little bit complex to think about what your actual benefit is from this deduction. You want to think about it a little bit more in depth. It also changes over time. So if you're talking to someone about investing in real estate, especially if you're talking to somebody who is going to benefit from you investing in real estate, they make commission possibly on the transactions, or if you are someone that works in the real estate, you want to take into consideration the impact over the life of the loan as well. Not just say, well, the real estate is going to benefit you from taxes, therefore it's a good idea. Again, it's way more nuanced than that, right? How some people are going to benefit, some people may not benefit as much. How big is the benefit, and what's the benefit look like over the life of the loan, given the fact that the principal and interest portions of the payments will differ, and therefore the benefit will actually decrease, in essence, over the life of the loan, because although you're paying the same amount on the loan, less of it is going towards interest, more towards principal, therefore less being deductible. So the mortgage interest paid on the rental proportion is also deductible, but this is reported on a Schedule E. Now, if you were in the business of real estate, meaning you're purchasing real estate and renting it out, or you're in some kind of real estate business, it's not your principal residence, then you would think from normal business components, normal business thought process, that you would get to deduct the interest because you had to pay for the financing as a normal business expense. You didn't buy the home to live in it. It's not a personal expense to you in that case. It's part of your business. And that's when, again, you would think that those kind of deductions are more likely to be deductible. Now, the IRS is skeptical on people that are the deductions on real estate because they call it passive income. And so there's arguments on whether passive income should have the same benefits as kind of active income if you're actively working, putting your time into something versus holding property, passive income, and so on. But in essence, if it's a business, you would think that you'd get the deduction, then you'd be deducting it on Schedule E. Now, you can imagine all sorts of kind of scenarios where you could say, well, it's a rental property, whether it's my vacation home or it's my home, but I rent a certain portion of it out and this and that. And so then you got some mix between personal and rental. And then you can dive deeper in the tax code and say, well, where do I deduct it in those cases? Do I have to split it out between Schedule E and Schedule A, and so on and so forth? And you also want to determine in those instances, if you're actively involved in the rental property, what is it, passive income or is it not passive income? So again, those, you could dive in the rabbit hole on those and go into a lot more depth, which we might do a little bit in future presentations. But just looking at the tax implications can be quite complex for different scenarios. So home mortgage interest is quite often the single itemized deduction that allows many taxpayers to itemize. Without this deduction, remaining itemized deductions would not exceed the standard deduction. In other words, if you don't own a home, or you're not fairly well off in that you have high like state taxes or some other kind of thing that's going to be quite large, even though state taxes are kind of capped now too. So if you don't own a home, then it's likely that you're not taking the itemized deductions, because these are the big ones that kind of push people from the standard to the itemized, which was kind of the intention, because they're trying to make, if you want to simplify the code, the tax code, it would be easier to kind of stop these special deductions and just have kind of a standard deduction. So in any case, these deductions are the things that could be the things that push people over to itemizing. But that gap, again, between standard to itemize is not something you're really getting a tax benefit on, because you would have got it anyway. So you could say, hey, I got to deduct this large amount of interest on my Schedule A, but the only reason you got the deduction is because it just barely got over the standard deduction. Then you didn't really get the benefit of that large amount, because you would have got the standard deduction anyways. So how can you really figure that out? You kind of have to do a tax projection if you're in that scenario. Got to get the software, and a lot of software is affordable these days, and run a projection, but without the property, and with the property, and run a projection with the amount of real estate taxes and the amount of mortgage interest, because those are the two big ones with regards to the home that could push people over. And then look at the actual impact with regards to the percent increase in your or decrease in your taxes, as well as the dollar amount that will change, and then consider the fact that your actual interest deduction will probably decline over time as the loan goes out over time. So how a mortgage interest deduction works: the Tax Cuts and Jobs Act, the TCJA, passed in 2017, changed the deduction. So there's been some adjustments to it. Note that this deduction, when you talk about it, they talk about it like it benefits kind of like the common person, and it does, because if you own a home, that's beneficial. But there's wealthier areas of the country, like if you're in a high cost of living area, obviously these laws, and this is why the national policies are kind of hard to really see how they're going to blanket the whole country and affect it evenly, because obviously if you're in a high cost of living area, you could be paying close to $1 million for a home, where in other parts of the country, then that same home might cost like $200,000 or something like that, and that's going to be a huge difference. Also, if you're dealing with people that are buying $1 million homes or something like that, and they're getting these tax benefits, then again, it doesn't look like those types of deductions are being helpful for the average person. And especially if you got like multiple homes that are worth millions of dollars, that like your second home or something like that, then it seems like that those deductions are not designed exactly to help. So now they put on some different caps in terms of how much of the deduction that you could deduct. So it reduced the maximum mortgage principal eligible for the deductible interest to $750,000. So once again, it reduced the maximum mortgage principal eligible for the deductible interest to the $750,000. It was at $1 million for new loans, which means homeowners can deduct the interest paid on up to $750,000 in mortgage debt. Again, for normal people, that would be a lot of mortgage debt, because that doesn't even include like the down payment. So that would be probably, for most people, sufficient. So, but it also nearly doubled the standard deduction, making it unnecessary for many taxpayers to itemize. So this is the one that really kind of leveled it out a lot, because they actually basically increased the standard deduction, which again is kind of good because it simplifies the code, and that would mean that no matter what, you get basically the standard deduction. But that also increased the gap between people that itemize and people that do not itemize. And so it also made the real estate deduction possibly less of an impact for that, because the standard deduction will have been gotten whether you take that or not. And those are the kind of changes, by the way, that you can expect could happen in the future. In other words, it's unlikely it'd be very unpopular for people to just say, I'm just going to remove the mortgage interest deduction. but they might do things like say, hey, we're going to move away from itemized deductions to try to get to more to a standard deduction, which kind of does a similar kind of thing in decreasing the value of that deduction for, many people. So that's one way they can kind of phase it out possibly. You can argue whether that be good or bad, but it's just something that could happen depending on, what happens politically in the future. And when you're looking at a long-term investment, you kind of want to take that into consideration. So how a mortgage interest deduction works continued. As a result, most went on to forego the use of the mortgage interest deduction entirely for the first year following the implementation of the TCJA, the Act, and estimated 135.2 million taxpayers were expected to opt for the standard deduction. So obviously more people are just going to take the standard deduction because you take whichever deduction is higher. So if the standard deduction is higher than your itemized, you'll take that. The mortgage interest happens to be an itemized deduction, which would weigh in on the itemized deductions. And so there it is. So by comparison, 20.4 million were expected to itemize, and of those, 16.45 million would claim the mortgage interest deduction. More than 80 million mortgages are outstanding in the United States, which suggests that the vast majority of homeowners receive no benefit from the mortgage interest deduction. So again, it really depends on your circumstances. And if you're talking to someone that's saying, hey, you got to do this because the tax code, it's tax benefit to do that, it's really dependent on what your circumstances are, and you got to know exactly, get a better idea of what the actual impact for taxes will be for you. Qualifications for a full mortgage interest deduction. In 2017, the Tax Cuts and Jobs Act, the TCJA, limited how much interest homeowners could deduct from taxes. Instead of single or married filing jointly, taxpayers deducting mortgage interest on the first $1 million, $500,000 for married filing separately of their mortgage, they can now only deduct interest on the first $750,000, $337,000 for married filing separately on their mortgages. Qualifications for full mortgage interest deduction. However, some homeowners can deduct entirely of their mortgage interest paid as long as they meet certain requirements. The amount allowed for the deduction is reliant upon the date of the mortgage, the amount of the mortgage, and how proceeds of that mortgage are used. As long as the homeowner's mortgage matches the following criteria throughout the year, all mortgage interest can be deducted. Legacy debt, meaning mortgages taken out by date set by the Internal Revenue Service, IRS, qualifies for the deduction. So in other words, when they passed in the law, oftentimes they're going to say, hey, we got this new law that we put in place, and this is what we want to happen from here going forward. But it's really difficult to put the new law in, even if you think it's the right thing to do from this point going forward, because obviously people made long-term decisions based on the prior law. So there's kind of two considerations from a policy standpoint. You could say, well, on the one hand, I think this is the way the policy should be. That's the way it should have always been. We should have put it that way. But, some other thing happened. They put this deduction in possibly, and they've overdid it or something on the deduction. And now you can't really reverse it entirely, because if you were to reverse it, you would be hurting the people that depended on the law. So you could kind of phase it out, right? So now you got this phase out thing. Well, if you've depended on that law prior to that, then we'll have kind of a legacy type of policy, and then we'll try to trim it back to what we actually think it should be, going forward from this point going forward. Qualifications for full mortgage interest deduction. The mortgages issued before October 13th, 1987 have no limits. This means that taxpayers can deduct any mortgage interest amount from taxes. Mortgages issued between October 13th, 1987 and December 16th, 2017, and homes sold before April 1st, 2018 can deduct mortgage interest on the first $1 million, $500,000 for married filing separately, taxpayers of their mortgage. For the latter, the sales contract must have been executed by December 15th, 2017, with a closing conducted before April 1st, 2018. Once again, referencing Investopedia, Mortgage Interest Deduction by Julia Kagan, reviewed by Leah D. Aradu on September 28th, 2021. Remember that as time passes, you might want to update or look at the information in Investopedia or other areas to look at that updated information. Another resource will, of course, be the IRS website, irs.gov, irs.gov.